Hi everyone, my name is Anil Gupta. I'm the mortgage broker dealing in home loans, investment loans, refinances, commercial and asset loans. And in the wake of last week's annual budget, I have been getting questions regarding the couple of major tax law changes related to the investment property. And in this quick video, I will try to explain those two major changes, including negative gearing and capital gain tax. In this video, I would not be covering the changes to the trust. So, proceeding with the video, two major changes happen and people are scared, if not scared, very confused that what these changes will mean to the existing investors in the market or the people who want to enter the investment market, the property investment market. First one being the negative gearing changes, the changes to the negative gearing. If you are already investor in the market with the property, you must be knowing what is negative gearing, but very quickly I will cover that. When you're in the expenses being the interest rate expense of the loan, depreciation and maintenance is more than your rental income of that property, it will be the negative balance, the negative loss, which results in the negative gearing, where the gearing means that you take that balance and claim against your other income, which will refund you tax back on that losses, the claim against your other income, and you will get the tax back from the government. For example, your losses in the first year, usually the one thing people who are getting confused or scared, they are missing, I won't say missing, but they are not putting importance to a point that the negative gearing is high in the first few years, let's say 4 to 6 years, and subsequently the property becomes the positively geared. So this negative gearing concept is the story of the first 4 to 5, 6, 7 years of the property investing. And let's say in the first year the losses are $15,000, and at the tax bracket of 35%, it will convert to the tax back of $5,250, let's say around $5,000 for $5,500, and that is your negative gearing for the first year. Subsequently, it will go down, and from the year 6 or year 7, you will start the positive cash flow. Positively geared, that property will become positively geared, and you will have the net profit, which will add to your income tax. So the changes what happen, I have categorized that into 4 categories regarding negative gearing, and the same for the capital gain tax. Category 1, you are an existing investor in the property market. You have investment property 1, investment 2, couple of properties, or 3 or 4 investment properties. You can still claim your negative gearing on those properties. If it is negatively geared, you can still claim until you sold that property. So if you bought that property before 12th of May 2026, that's the announcement of the federal budget, the ruling under the investment property tax laws. Before that, if you have bought the property, you can still claim the negative gearing until that property is sold. Category 2, you are buying a property which is an existing property, that is not a new property, existing property. You can say old property, if not old property, but already built and already existed before this announcement. You can claim negative gearing until next year 30th of June 2027. So let's say you bought a property after the announcement, let's say this week you have bought a property, you can claim negative gearing until next year 30th of June 2027. Category 3, you are buying an investment property after 30th of June 2027 next year. That means that from 1st of July 2027, you are entering into a investment property market, or you are buying additional investment property. The losses will not be claimed against the other income if you have bought a property after 30th of June 2027. That doesn't mean the losses are dead. No, this is the biggest misconception. Losses are not dead. Negative gearing is not dead. The only thing change is that you will, instead of claiming instantly in that particular financial year, you will carry forward those losses against the future income from the investment property. You will claim those losses in the future year against when the property becomes positively geared, positive cash flow. You can claim those losses in those years. The losses are not dead. For example, in the first year, the losses from the investment property is 20,000. For example, just for the sake of numbers, in the year 2, 16,000, year 3, 11,000, and so on. In the first 5 years, until the property is becoming positively cash flowed, the total losses are 53,000, for example. From year 6, the property is becoming positively cash flowed. So until you can claim that $53,000 losses against the future income, the future income comes down to 53,000. You can claim that it will still give you the tax benefit, but not in the first 5 years. After, from the year 6, when the property is becoming a positively cash flow. One very important change. Let's say you decide to sell the property in the year 5, just before, or year 4, before the property become the positively cash flow, positively geared. Still, those losses are not dead. You can claim against the capital gain. Just note this point, very important point. The losses are not dead. Negative gearing is not going anywhere. Even if you decide to sell the property before it becomes positively cash flowing, you can still claim those losses against the capital gain. Let's say, for example, you sell property with the profit of 300,000. You can still claim that 53,000 against the profit of 300,000. First, that losses will be deducted, and then the capital gain calculation will start after the deduction of this $53,000. So the losses are not going anywhere. Negative gearing is not going anywhere. Category 4. If you purchase new property which is newly built or structurally newly, like there is a definition out there. What comes under the new properties? The negative gearing as in original form is still there. So you can still claim the negative gearing on the new properties. Very important thing, properties bought under self-managed super funds are excluded from this rule. New text change. Properties bought under SMSs are does not fall under this change. They are excluded. And then there are other exemptions, which is a topic of another time. But this is negative gearing change that happened in the federal budget. Negative gearing is not going anywhere. The losses are not going anywhere. You can still claim it. Only thing is that instead of claiming straight away in the first 4, 5, 6 years, you have to wait for the property to be positively geared, and then you can claim it, or you can claim against the capital gain. That's the negative gearing. Second major change, capital gain tax. Capital gain is when you sell the property at profit, the sale proceeds is higher than the cost base, that is a capital gain. And you have to pay tax on that capital gain to the government. CGT discount, capital gain discount. The concept of CGT discount took took a birth in the form of inflation. The argument was that the whatever the increase in the price of the property is there, there is a part there is a part of inflation also there. So the increase in the value is not only the purely the increase in the value of the property, there is a part which has increased because of the inflation in the value. To compensate for that, the inflationary part in the increase of the value, until 1999 there was a discount based on your indexation method. In 1999, to promote the property investment, to promote this part of the economic activity, that method was changed to the 50% CGT discount. 50% discount straight away if you hold the property for 12 months. After that, any capital gain will be discounted by 50% and you will pay tax on the remaining 50%. The CGT discount is coming back to the indexation. Different arguments of the people, why government has done it. People are in favor of these changes. There are people who are against these changes. People are predicting the fall in the market and all that. My take on this is that, again, nothing big has been, like, there is not a big change. Yes, there is a change from the indexation method. The discount will be little bit less than the 50% discount, and that will result in a more tax. But I will come to that. Again, I have categorized the change into 4 categories. The category 1, if you have purchased the property and sold before 1st of July 2027. For example, you bought the property 1st of January 2020 and sold before 1st of July, that is 30th of June 2027. You can still claim that 50% capital gain discount. No change. If you have bought and sold before 1st July 2027, no change. You can still claim that 50% discount. But if you are selling purely to be in this category, you may be rushing yourself in selling the property. That is your decision, your calculation, how you see the economic activity. That is your decision. Category 2, purchased before 1st of July 2027 and sold after July 2027. For example, you bought a property in 2020, 1st of January 2020 for 500k. And you will be selling that property, for example, 1st of January 2032, that is in 12 years time, for 1.5 mil. So the capital gain will be 1 million. You bought it for 500k and you will be selling for 1.5. In 12 years, the capital gain will be 1 million. So the capital gain discount will be calculated in 2 stages for this category. First category, from 1st of January 2020 to the 1st of July 2027 next year, the discount will be calculated as per the 50% discount. CGT, capital gain tax, will be the discount will be 50%. And from this stage, 2027, July 2027 to 2032, the capital gain discount will be calculated under the indexation method. The question comes here is that how you will determine the value of the property at this point. So ATO is giving you 2 choices. 1, seek the valuation on this date and keep the valuation with you. Get your property valued and have that, your accountant, your whatever way you want to get that valuation done, keep the valuation, have that valuation done on this date and keep that valuation. for the future whenever you will sell that property. So you have that valuation on this date. Or when you sell the property at this date, you can use ATO's estimate at the time of the sale. So ATO will be like they are in process, or they have already done that. I'm not sure. But in the budget reforms, it says that the ATO will give you the estimate, the value of your property on this point, at this point, and you can use that valuation for the first part. Capital gain will be 50% discounted from this point to this point, and the second part from this point to this point, it will be discounted under indexation method. So whatever the appreciation, what's my take on this? Whatever you have got your appreciation until, let's say, this year or next year, don't rush to sell. Let's say you have 500k capital gain until next year, you will still get that 50% discount for the existing property investors, category 1 and category 2. From this point, it will be indexation method, which is not very bad. I have calculated different scenarios. It is not that bad as it sounds. I have done the ATO and the tax reforms, also given few examples. I have tried those examples. I have put different values to those examples, use different indexation rate. 2.5% up to 3% inflation is happening every year. So if you will take those rates, it's not that bad. So this is category 2, most complex one. It's not complex. It's complex in a way that it will be calculated in 2 parts, the capital gain discount. Category 3, you bought existing property, which is not new, existing property after 1st of July next year, 2027. The capital gain discount will be calculated under indexation method for the category 3. If you are buying, if you are trying to enter into the investment market, property market, or you are adding your the property to your property portfolio. Though for those properties, the capital gain will be, discount will be calculated in the indexation method. Category 4, you are buying new property, which is newly built, or there is a definition what comes under the new off the plan property, new property, newly construct. You have choice of getting that 50% discount on capital gain, or you can go indexation plus minimum 30% tax. What is minimum 30% capital gain tax? Is in the year when you are selling that property under category 4, new property, like in next 10 years, 12 years, 15 years, if your tax bracket after your income and capital gain combining both, and your tax bracket is still under 30%, on the capital gain part only, you will be still charged 30% at least, minimum 30% on your capital gain part. That is a minimum 30% rule. And for the new properties, you can have a choice. You can go either with 50% discount or indexation method. Now, my take on these 2 rules, I'm not trying to sell you anything here, but before jumping to any conclusion or selling your property for the existing, especially for the existing investors, please work on these few points. The Australian economic standards, economic bottom line is very strong. I'm reading or hearing different things that the property will crash, property will go down 4%, some are saying 8%, the property dream is over. I personally don't think so. If you are a new investor or trying to enter in the coming years into the property market, I think it still is a very solid, is a very strong wealth building activity. You just need to be careful how you will get the deposit to buy that property, 20% deposit. Are you able to cover that negative cash flow for the first few years? Maybe $1,000 a month, because you won't be able to claim negative gearing. So maybe $1,000 a month. If you are able to manage that cash flow, extra $1,000 a month, and you are buying in a suburb or a place where you will get a tenant minimum 23 out of 24 months. If you are a new investor and you are negatively geared, so you don't want your property be out of rent for long. And at last, I believe people go for appreciation on the top. I think you need to worry about the deposit to buy. You need to worry about the $1,000 a month extra if you have or not. And you need to worry about the suburb or the location where you can get a continued tenant. And the location comes, like location is the part of the process, but then the appreciation. It is still a solid, very strong wealth building, and once it gets positively cash flowed, it's wealth generating. You are sleeping and it is still generating the wealth for you. Any questions? Please let me know. Thank you.